Hello guys, my name is Mikey and today I would like to tell you more about ICT and SMC or smart money concepts. Lots of you wrote me that you would like to see some basics of these ICT or SMC concepts and you don't understand how the indicator works, so I would like to tell you more today about this topic. You can find the ICT SM trades indicators by typing ICT SM trades, and here you can find the free indicator and here you can find the premium indicator. If you want to get 10 days free access to the premium indicator, please write me an email to my email address. You can find it in the description of this video, or it is ict.trades.indicator@gmail.com. So you can also read more on these indicators, and you can see some ICT or smart money concepts here, and the same is on the premium indicator. So I will be reading this and I will be explaining on the chart what does it mean. Okay, so let's get into it. Indicator looks for ICT and smart money trades or on any time frame. These types of trades reveal how the big institutions, banks and hedge funds trade with big money. If they want their very big positions to be filled, they need to find areas in chart where the majority of the money is sitting. Where is it? Where is the majority of orders placed? Right below supports or right above resistances. These orders are stop losses or stop orders. Okay, so the majority of the money is sitting above resistances or below stop loss or below supports. Why? Because this is resistance. Okay, we have first bounce down here, so the price bounced here. Sorry, here. And it went down, and then when it came here, it bounced down again. So we have two touches, first here, second here. This is the first pivot high, this is the second pivot high, and this is called resistance when we have minimum of two touches. So we are assuming when the price will come close to this resistance in the future, it will bounce again to the down. Okay, so this is the resistance. And we can find, for example, here, this is the support. So this is the first pivot low, price went here, bounced up, and when the price went or came close to this support, it bounced up here again and here again. So we have three touches. This 1, 2, 3, and when the price will go down again, we are assuming that it will bounce up again, because it bounced 3 times in the history, so why wouldn't it bounce again? Okay, so we are assuming this by the history of the price. So this is called support and resistance, and as I was reading from the description, so I can read it one more time. Where is it? Where is the majority of orders placed? Right below supports, right above resistances. These orders are stop losses or stop orders. So when there is a resistance, people who have sell trades, for example from here, they saw 1 and second touch, so they are assuming that after the second touch the price will go down, for example here to this low. So where they put their stop loss, right? They will put their stop loss probably here above this resistance, because they are assuming if the price is going close to this area, it will bounce down, so their stop loss wouldn't be hit. So when 10,000 or 100,000 people would do this, their stop losses are, all the stop losses are here in this area. Okay, so here can be, for example, stop losses in value of $1 billion. Okay, stop losses. So where is the stop orders? I continue in reading. So they need to push the price, the big money or the smart money, to these areas, take all the available stop losses and trigger all the available stop orders in order to fill their positions, and then push the price to the opposite side to make profit and retail to lose. So their orders are so big that and for example, when they want to sell here, they need the opposite side. When they want to sell, for example, for $1 billion, they need opposite side who wants to buy this $1 billion to make this position or this order filled. Okay, this is how the market works. You need two sides, buy and sell, and it has to be filled from one side to another side. So if they want to sell here $1 billion, they need opposite side who wants to buy this $1 billion. So, and these stop losses can be something good for their very big orders. So what they do is they push to these levels. They trigger all the stop losses of these retail traders, and when their orders are filled, they want to turn the price to the opposite side to make profit here. Okay, so this is the main concept of the smart money. They need some big orders for their orders to be filled. And where are these orders? Where the majority of money is sitting, and it is somewhere where is very much or very big amount of stop losses or stop orders or something like this. So it is probably above the resistances and below the supports. Okay. So as we can see here, so this is the resistance marked by the indicator. This is the first pivot high, second pivot high. This line is the resistance by the highest pivot high. And here is the push or the liquidity grab. This is called liquidity. This is this X sign is liquidity grab. This is the highest point in this liquidity grab. And then, as you can see, this is the turnover of the price to the opposite side. Okay, so I'm continuing. I continue in reading. Indicator looks for support or resistance. This is the resistance. Okay, areas which are represented by dotted lines. These support resistance areas are created by minimum of 2 pivot high lows. This is the 2 pivot highs. Every pivot high low that creates the support or resistance area is marked with diamond label. This is the diamond label. The super resistance area is called liquidity. Okay, so these areas are called liquidity because they are liquid, because the lots of money are sitting nearby that zones. For example, in stop losses or in stop orders. After liquidity is created, indicator looks for liquidity grab, mostly represented by fast spike to this area. It is labeled with X cross, as you can see here. And then price should go fast to the opposite side of the created structure. Indicator considers as a created structure everything that was created on the other side of the candles from the oldest pivot high low. This is the oldest pivot high low from these two. Oldest pivot high low, which creates particular liquidity. So from this candle, it is looking for the lowest candle, as we can see, until the liquidity grab. So can do it like this. So from here to here, which one is the lowest candle? It is here. So here is the marked as the opposite structure. Okay, by this dashed line. Okay, considers. Okay. So, for example, if liquidity is created with 3 pivot highs, indicator looks at the oldest pivot high, and from there it is looking for the lowest low. Okay, so this is the lowest low. Under this lowest low is dashed line, which means that this level should be broken with closed candle. Okay, which is here. This is the closed candle under this dashed line. This action is called market structure shift, or break of structure when the price shifted very fast from highs to lows. So from highs it shifted very fast to the lows. Okay. After market structure shift, when the price went fast to one direction, there was some imbalances in prices. In our example, selling pressure was a lot bigger than buying pressure, and there were created some long untested bearish candles. These untested areas in candles are called imbalances or gaps or fair value gaps. These are labeled with rectangles. It is expected that these gaps will be tested in near future to balance the market. So as we can see, this is the first fair value gap, this is the second fair value gap of this bearish move. So it is imbalanced because there are a lot much more sell orders than buy orders. Okay, so there are created some imbalanced zones here to here, and this is, as you can see, I can do it like this, and I can change it to the white color and make it thicker. Okay, so as you can see here, this bearish move happened, and it is imbalanced, and until here it is balanced until here, and this is not balanced. Okay. So this is imbalance, waiting for the market to be balanced. As we go down, this is the second fair value gap, and here is the imbalance zone. It goes down and it goes up, and it is, as you can see, it is balanced until the middle of this fair value gap. Okay, so these are imbalances in price because there are more sell orders than the buy orders, and the market works in the way that he wants to or it wants to balance itself. So there cannot be only the bearish candles, and the price cannot go only down. It has to go down and it has to go up. Okay, it has to go down and it has to go up. It has to go down, it has to go up, and this is balancing itself. As you can see, here are bearish candles, here are bullish candles, and it is balanced. Bearish candles, bullish candles, bearish candles, bullish candles. It can go only down all the time. Okay, so the market has to be balanced, and it is expected that when we see these fair value gaps or imbalances, that the market will retrace back to these zones and then push to the default direction again. So as we can see here, it created imbalance, it went down, it retraced to the imbalance, and it went more down afterwards. Okay, so I continue reading. We can put limit orders into these gaps and await some retracement after market structure shift to open our positions, and after the positions are opened, we can expect trend continuation in the direction where market structure shift was made, away from liquidity grab. So stop losses can be placed above or below liquidity grab candle marked with X cross. So when we see this type of trade, where is liquidity grab, and here we can see the market structure shift. It closed under this opposite structure. It is closed here on this candle. When this candle is starting to be printed, so we want to enter on the retracement to the fair value gaps or to these order blocks candles, or we can use Fibonacci as well. So after this candle is closed, we can do it like this, and we are waiting, for example, for this golden ratio 618, or if the price is going more down, as we can see here, we are awaiting it here, and but it never went up here. So the better choice in this scenario would be this fair value gap. So assume that we would enter after this candle is closed, because the trend is shown. We want to go down because we closed under this opposite structure. This was just the fake. This was just the liquidity grab because here are so many orders, so many stop losses, and big money needs that stop losses, so they pushed the price here and they created fake bullish, fake bullish move, and then they turned the price down and they closed under this opposite structure. So we know that we want to go down. So after this candle is closed, we would like to enter in the middle of this fair value gap. So stop losses can be put, for example, for here, or to the wick or to the body. I like to the body because we have better risk reward ratio. So where can be our take profit? It could be here to this low, okay, because this is as well liquidity. And as we can see, the price from here, it went down and it started retracing here, and it would be, or our position would be opened, and after that we would go down to the profit, and yeah, here we would have profit for 3 risk reward ratio almost. And after 1 risk reward ratio, we would like to put our order to break even, so we don't want to lose anymore. Okay, so after here we put order to break even and wait for our take profit, which is somewhere here. Okay, so we want price to retrace to our fair value gap or to this order block. This is the yellow line. Order block is the last bullish candle before the big bearish move. Okay, so price tends to retrace here as well. It's something similar to fair value gap, so we could have the position enter here, but the price never retraced here, so the better choice would be this middle of the fair value gap. We don't want to enter here, okay, here, for example, on this order block, like this, because the move already happened here, the bearish move. Okay, so this is another story. Okay, this is not this is not for this trade. Okay, so this trade already happened here. It retraced here and the trade happened here with this big short, with this big move down. Okay, so I'm going to delete this and I continue in reading. In settings of the indicator, you can set whether only long or only short trades will be shown. This is something about the indicator settings. Long trades are green and short trades are red. Okay. So this was all for the ICT and SMC concepts. I hope I explained it a little. I know my English is not the best, but I try my best to explain. So I would like to show you new features of the ICT SM Trades Premium Indicator, and I would like to show how to set alerts. At this time, it happens sometimes that alerts are not working, so I need to do this, to save it and reload the page. Sorry. I'm happy that you see it live, because to some of you it happens that sometimes alerts are not working. It's not my fault, it's TradingView poor services, so I'm sorry for that, but I can do nothing about that. So okay, as you see, after reload and saving the chart, it is now green, so we made it. Okay. And now we can set alerts here. As you can see, we have alert for liquidity grab, long or short. This is the only long liquidity grab, only a short liquidity grab. This is the market structure shift, long or short, market structure shift long alert, and market structure shift to short alert. Okay, and here we can see how often it should trigger. This is the only ones. This is the once per bar close, or once per minute. easy. Okay, and we can add alerts as here as well when we select ICT SM trades, and this is the same as previous. Okay. But guys, please, if you want to create liquidity grab alerts, so these three, make sure that you have checked this option, because if you have not checked it, you wouldn't see the live liquidity grabs that you get alerts for. Okay, so if you get alert for liquidity grab, it is a live liquidity grab, and if you haven't checked this option, you wouldn't see it. So some of you thought that the alerts are broken or something like that. So just make sure that if you have alerts for liquidity grab, you have checked this option to see live liquidity grabs. So for example, this is the live liquidity grab. Okay, this is the resistance, and here we can see this is the liquidity grab without market structure shift. So make sure that you have checked this option if you are using alerts for liquidity grabs. Okay, and now I would like to show you some new features of the premium indicator. One of them is from now you can show daily bias EMAs. These EMAs are used for calculation of the daily bias. They are two EMAs from daily time frame. One is stronger, one is weaker. The stronger one is by default with orange color, and the weaker one is by default the stronger is with orange and the weaker is with yellow color. If I turn them on, yeah, I can see them. This is the orange, this is the stronger, right? Yeah, this is the stronger and this is the weaker. So the weaker is below the stronger. It means we are in the downtrend from the daily time frame. We can go to daily, and we can see that the yellow, the weaker, is below the stronger. So we are in downtrend. But be aware that you can set the frame of the trend that you want to see. This is the I can say small frame of the trend. It is the stronger is 50 candles back, and average of 50 candles back, and the weaker is 25. So it is framing, I can say, only this price action, because it is from here it is the downtrend. Okay, but if we want to see this frame, for example, and we can see that we are in the uptrend from the higher trend, I can paint it with this. We are in a uptrend from the higher frame, so we have to set these EMAs to bigger values. So for example 20 and 100, 200 and 100, and as you can see from this higher frame of the trend, we are in a long. Okay, so this is only current daily bias. So the weaker is above the stronger, so we are in a long, but it is considering the bigger frame. If we want to consider the lower frame, for example only this price action, only this, we need to put the values to the lower values. Okay, so for example 50 and 22. It's up to you how big frame you want to consider the trend, so put it to your preferred values. Okay, so as we can see, this is representing only this frame, and from this frame it is in a downtrend. Okay, so we can see daily bias short. Okay, this is show daily bias EMAs. The next new feature is that we have we have 3 session times. By default, this is London, this is New York session time, and this is the third one is Tokyo session time. We can make them active to see them when clicked in this option, show session. So if I click show session and I have active only this, I will see only this London session. Okay, so I click OK and I go to 15 minutes, and as you can see, this is the London session. Here is the London session, okay? And the filter trades by session is working on as well, only with is working with active sessions. So if we click now to filter trades by session, it will disappear because it is considering where is the liquidity grab located. And as you can see, the liquidity grab is one candle out from that session, so it is not printing it. Okay, so the liquidity grabs needs to be in these sessions, which has to be filtered. Okay, so it is working in that way. Okay, so you have 3 sessions, and you can set much more colors for these 3 sessions, for the daily stronger EMA color and daily weaker EMA color, order block color, and the next setting or the last new setting is show more history data. This was created because of loading indicator loading time issues. It was loading too long, so at this time I am printing only 1000 candles back in history. As we can see, this is 105 bars, and if you want to see more trades for the backtesting purposes, just click it, but you have to wait for, I don't know, 20 seconds or something like that, and it will show you a lot more trades. So we can wait for it to load. Still loading. And yes, we can see a lot more trades, okay? But I will turn it off to let the indicator be fast. Okay guys, as I said at the beginning, if you want to try the 10 days free access to the premium indicator, please send me an email to the email address. You can find it in description. It is ict.trades.indicator@gmail.com. And if you want to be notified when new videos are uploaded, please subscribe, comment, leave some comments. What new videos would you like to see in the future? What topics do you want to understand, or do you want me to record about? And that's it. Yeah, so guys, thanks a lot for watching and have a nice day.